5 of the best ETF investments for 2021. Hi YouTube, welcome to our channel MoneyTrain Wealth. On this channel we talk about investments, investment strategies, the best investments move, and hustles that will lead you to financial freedom. If you are seeking millionaire status in a few years and you want to learn more about strategies like these, please like, subscribe, and hit the notification bell so that you do not miss any updates. In our previous videos, we looked on index funds and how they are different from mutual funds. We also introduced exchange-traded funds or ETFs. In this video, we will be looking on the 5 best exchange-traded funds or ETF investments for 2021. But before we get started, a few things to consider. 1. Your investment objective. 2. And most importantly, cost. An ETF with the lowest expense ratio is the best. A good point of reference is 0.12% or below is the expense ratio. In our next YouTube video, we will be looking on the 5 best ways to save millions in under 10 years using these types of investment strategies. So what is an ETF? We will be looking on the 3 important investments areas. 1. ETFs versus mutual funds. 2. ETFs versus index funds. 3. The risks of investing in ETFs. What is an ETF? At their core, ETFs are funds, which can be comprised of stocks, bonds, commodities, or other assets, that are designed to track a particular index. Like stocks, ETFs trade daily on stock exchanges, their prices fluctuating throughout the day. Again, a good point of reference for low cost or low expense ratio is 0.12% or below. ETF versus mutual fund. Mutual funds and ETFs are similar in some important ways. Like mutual funds, ETFs allow investors to instantly spread risk over a huge swath of investments, sometimes hundreds at a time, as opposed to buying a stock here, a bond there, and so on. Both give investors an easy way to become extremely well diversified without spending the time and transaction costs to build a diversified portfolio. Diversification is a beautiful thing in any portfolio, but it's particularly important for retail investors because it lets them participate in a market's upside with lower risk and volatility than a 3 or 5 stock portfolio. What are the advantages of ETFs over mutual funds? Almost all of the differences between ETFs and mutual funds favor ETFs. ETF versus index fund. There is a subset of passive mutual funds, called index funds, that aims to compete with ETFs on their home turf. And here the winner is less clear. An index fund is a mutual fund that tracks an index. Both ETFs and index funds shift an underlying portfolio assumption from manager-driven alpha to market average-driven return, says Brian McDowell, wealth manager at Cascadia Wealth Management. Since there's no active management involved, index funds tend to have lower fees than active mutual funds, but not as low as their ETF counterparts. For example, the Vanguard 500 Index Fund, ticker VFINX, which tracks the S&P 500 index, has an expense ratio of 0.14%. Meanwhile, the Vanguard S&P 500 ETF VU has an expense ratio of 0.03%. We spoke about this in our previous videos. The lower expense is in part because ETF managers don't have to conduct daily accounting of redemptions and purchases. These daily redemptions also force an index fund to trade more frequently within the fund than an ETF. What are the risks of ETFs? ETFs are not a sure thing, as no investment is. Being too closely tied to one sector or index means that a crisis can immediately affect your bottom line. Asset allocation spreads the risk but doesn't eliminate it. The universal rule of no risk, no reward still applies. Another thing to keep in mind with ETF investing is how well a particular fund achieves its goal, that is, how well it replicates the returns of an index. The difference between the index's return and the fund's return is called the tracking error. The major trade-off of ETFs stems from its defining nature. Indexes are diversified but may not carry the same explosive return potential of an individual stock. Investors who are a bit more accepting of risk might want to look into instruments that can provide more dramatic returns, excluding leveraged ETFs, which are rife with drama. ETFs are more suited for investors whose taste for risk is less strong. So let us look on the 5 best ETF investment this year. 1. The Vanguard 500 Index Fund ETF. ticker symbol VU, with an expense ratio of 0.03%. This ETF invests in stocks in the S&P 500 index, representing 500 of the largest U.S. companies. The goal is to closely track the index's return, which is considered a gauge of overall U.S. stock returns. This ETF also offers high potential for investment growth. Share value rises and falls more sharply than that of funds holding bonds and is more appropriate for long-term goals where your money's growth is essential. 2. VNQ Real Estate ETF. Ticker symbol VNQ. With an expense ratio 0.12%. This ETF has a 4% dividend yield that creates a lot of generational wealth. 181 individual real estate investment trusts rights. It is comprised of commercial real estate, retail, offices, healthcare. This produces a 9% return on investment of the last decade. Expense ratio is 0.12%. 3. The Global X Cloud Computing ETF. Ticker symbol, CLOU. The CLOU ETF outperformed the market by 40% in the last 12 months. This is a technology funds with the integration of cloud services. With the proliferation of cloud computing and a high demand for storage elasticity, this is a great stock to watch as we invest in 2021. 4. SPDR Bloomberg Barclays High Yield Bond ETF. Ticker symbols JNK, fixed income or bond investments. This comprise the safety of bonds but the upside in stocks. Because these funds are riskier, they are prone to do bad in a recession, but they will create an upside as the economy grows after the recession during the pandemic as the economy improves. These funds are raking in an amazing returns and the stock market has definitely been very strong over the last few years, but there are no guarantee that this growth will continue. 5. Schwab Broad Market ETF. Ticker symbol SCHB, with an expense ratio of 0.030%. Schwab U.S. Broad Market ETF SCHB is one of the best core U.S. stock funds available. It effectively replicates the composition of the total U.S. stock market, which has been hard to beat over the long term. As far as passive index funds go, the Schwab Broad Market ETF is one of the best products on the market. It should do an excellent job of tracking the overall performance of the stock market over time, and will do so at a bare minimum expense of 0.030% is great, so investors will get to keep most of the gains. Finally, if you are planning to invest in these funds, you can do so through Vanguard, Fidelity, or Schwab. Fidelity does not have a tracking ETF, but they sell the others at no fees, no commission on trades. You can buy Vanguards at Fidelity. Please note, we are not a paid sponsor for Fidelity, Vanguard, or Schwab, and as an investor, you should do your due diligence. For the sale of ETFs, the Fidelity website states that there is a 1 cent to 3 cents per $1,000 of principal. That is very cost-effective to investors. Opening a Fidelity account takes only 10 minutes to complete, and these are similar to Vanguard and Schwab's processes if you prefer those brokers. So there you go. Those are our top 5 ETFs for saving and investing your money starting this year. Please share what you are investing in below in the comments section and how you are investing. As we go through this journey, we need to start with a changed mindset. Please go to our description below and select and click one of our books of the month. This is our quote for the week. Many of life's failures are people who did not realize how close they were to success when they gave up. Thomas A. Edison. Thank you.